Hey, welcome to the exchange. So Redfin just reported their Q1 of 2022 earnings. Actually, it wasn't that bad. It was overall a mixed bag, but it was pretty positive on some of the aspects there. So they reported $597 million of revenue, which is well above expectations of $553 million. Earnings per share was negative 81 cents versus expectations of negative 1.06 cents. Let's look at the actual financials real fast and see what's going on potentially with Redfin. So this is a financial model I built. If you've seen my last video before, it's the same thing. I updated it for the actual updated projections and updated quarterly guidance they have. This is annualized though, from 2022 to 2026. Let's start with a little top line revenue. I'm saying right now $2.5 billion of top line for 2022, which is a little bit below expectations. I mean, I think Wall Street's having right now about 2.6, 2.7 billion. This is a little under that guidance there, but I mean, some of these areas were not that positive for overall revenue. Brokerage revenue, I mean, you still look at 2020, 2021. I mean, it's a massive growth rate there. The growth rate now is really high single digits. I mean, the market is slowing down a little bit on the brokerage side, so they're having issues there. The partner side dropped off, so basically revenue dropped about negative 20% year over year for Q1 of 2022, which, just for clarification, Q1 is typically the slowest or what kind of the worst quarter they have of all the quarters. And what they were saying is partner revenue was down 21% on a 13% decrease in transactions and mix shift to lower value homes. The decline of partner transactions is a result of normalizing mix. So it's basically saying, hey, 2021 was a hot year overall. This is going to normalize down to kind of that lower levels. Potentially, we're going to see the kind of that 40,000 or 40 million plus levels we're seeing right now. Whereas 2021, basically an anomaly year, was well above normal, and that's what's happening right now. Properties revenue grew quite a bit. I mean, they are now slowing down. Unlike Zillow, which killed this entire category, they're still going to grow pretty aggressively in 2022 and beyond, according to how they're talking right now. Rentals revenue, this is an early segment they're actually doing right now. It's grown quite a bit. It's nothing really crazy to highlight here. The growth rate's really on target, on projections, what they're actual guiding. Basically mortgage originations. They acquired Bay Equity, which is a mortgage basically service provider. Originally, they were saying, hey, this might be $350 million in 2022. Current growth rates and projections for outlook for Q2. I mean, I'm saying 290, maybe $300 million potentially for the mortgage revenue coming out of here. And the intercompany elimination, that's just some like restructuring charges they had. So really all this gets down to is $2.5 billion, which again, a little bit below the actual guidance that Wall Street has, I think, right now. But this is probably a little more conservative side for actual revenue overall base. Now, looking at the cost of revenue, this is what the big one is here. So the big one you highlight right now is really the real estate services. It's not necessarily the cost, it's the margin. I mean, they've had a massive margin compression. I mean, we're going from 30% to 16% roughly, year over year. I mean, that's just a massive hit. And part of that is the partner side, which rolled up into this, which has calmed down quite a bit. And the costs have gone up there. But really, it's the brokerage side. It's really just the costs have gone up very, very drastically. Let's take a look at that real fast. So this is from their earnings presentation. This is a breakdown basically of their cost associated with basically the brokerage revenue side and the partner revenue side. So this is Q1 versus Q2. This is basically looking at gross margin, which you see right here. I mean, it's just the personnel cost. So, I mean, I think they've had a lot of churn and just overall real estate agents at Redfin. Also, now they have to pay those higher premiums, higher prices, even to retain the talent they already have right now. So you can see, I mean, it's a negative 1,060 basis point, which basically means 10.6% margin compression right there, which for any company, that big of a margin compression is horrible. It is very, very, very bad. Now, hopefully this is a short-term blip and they can recover the margin a little bit, basically going into 2020, later 2022 into 2023, as we kind of out of this like high, kind of price wage inflation area we're in right now. But again, we don't know. I mean, if this continues, I mean, this will be very, very bad for the stock overall. But I think personally, I think it's probably a short-term blip. It's based nature of the economy right now, where you have like low labor, basically supply and high demand overall. So overall property revenue was much higher than I was expecting. I was expecting maybe 2-3% potentially in Q1. I mean, they're at 5.5%. So I mean, I was worried about this blowing up potentially with a housing downturn or like a housing crash. But I mean, they're doing very well. I mean, it's not super high margin though, but the overall base, I mean, is pretty high overall. And there will be well over $1 billion in 2022. So I mean, 2022, I mean, there might be $60 million or plus of profit potentially heading to the bottom line. Overall rentals revenue, this category is growing. But again, it's super high margin for them. So I mean, again, the faster they can grow this, it's just going to keep adding the bottom line because it's 80% margins. It's absolutely fantastic category of their business overall. And if this can accelerate even faster than the properties business, that to me is absolutely totally fine. That for me is success. Actual mortgage origination revenue and fees and everything else too. I'm saying, hey, $250 million of cost, $290 million of profit. I'm saying about $40 million of profit drops the bottom line. Again, it's not great, not terrible. This overall is a pretty small baseline as a percent of their total revenue. So we'll see what happens with that. But really big thing to notice here is a lot of these costs have gone up quite a bit. But also U.S. market share, for them, is almost flat. It's like a 2 basis point difference. It's not much of a change there. as kind of these costs and cost structures have gone up overall. So what's basically really happening is the market's the same size, the costs go up, the revenue's a little bit lower than I would have thought. So right now you're having basically margin compression across the board, across most of the categories. Overall, on the OpEx side, there's growth there, which is not surprising. But what they're saying right now is basically, we're really shooting for about 24 to 26% of revenue, basically is a total OpEx or operating expenses percentage. Again, I'm saying right now that 23.5, it's a little bit less. This might be some Q1 kind of, or it's a lower number overall, but we'll see how after Q2 and Q3, basically summer buying period, if this actually stays at a lower level potentially. But they absolutely cannot get anywhere near as 27% basically from OpEx from 2021. The market's just not growing that fast. It's not, overall dynamics are not changing that fast. Now, if revenue were to, post, recession or post anything else, or accelerate, past that, they can grow their OpEx accordingly. But right now they need to get very cash conscious and very conservative with their OpEx, make sure it doesn't get too out of control too fast. But we're looking at this, operating income, it's actually like one of the most unprofitable years they've had, I think ever actually. So, which isn't bad because they are trying to gain market share. They are trying to grow potentially. So, if that works, they're going to be fine long term. Short term, it's going to be a pretty ugly year overall. Net income, I'm saying negative 244 million. EBITDA, I'm saying negative 72 million. Again, EBITDA should be positive. It should keep growing as we move forward, 2023, 2024 and beyond. Net income though, it's just straight negative overall. Not massively negative, but it is negative. So they will need to raise cash, year over year potentially to help, basically pad their balance sheet, make sure they're actually staying cash viable. But overall, my thoughts are this is an EV, so enterprise value versus EBITDA multiple. I'm saying optimistically, which I think is a little optimistic, is $14.33. The more conservative estimate, or like a baseline estimate, is $10.75. If it's like a true like recession or like depressionary times, this might be a 3x multiple. So this stock could be $5 potentially if we go into a pure straight, hey, housing crash, recession, downturn, etc., which the fears are there right now, but I don't think it's as likely. If I had to guess, play it safe, I would play the 6x number right here is probably your best bet. The upside really, I think, is like about $14 potentially. But again, this could change though too. This could change drastically pretty fast. And like I mentioned in my last video, if the housing market corrects, this properties revenue is going to get absolutely sucked away just because they're going to have to basically fire sell some of these homes or potentially liquidate some of these homes pretty fast, maybe potentially at major losses too. But we'll see what happens. So this is actually interesting. This is from a CEO of Redfin. He actually got asked about a housing bubble or housing crash implied question yesterday on the earnings call. But this is actually what he says. So the final thought is just that when people talk about a bubble, that they talk about speculation where you're not buying the asset because you actually want it. But this is not a bubble in the strict sense because the need for housing is profound, emotional, and deep. People want to live in their own home. They are not just investors buying a house. And so I don't think people are over their skis on the mortgage. I don't think we're going to see a major increase in foreclosures. That means the inventory is probably going to stay low for structural reasons, and you're not going to see a massive collapse in prices. There's always that possibility, but it would be very surprising to me. So overall, I'm saying it's like, hey, people are buying houses because they actually want to live in them. They're actually buying like single family homes. They're actually going to use them as a primary residence, etc. Which if that's the pure case, he is absolutely correct there. The problem is though too, there's also vacation properties. People have second homes, etc. There's institutional investors out there too. They actually release an institutional investor kind of percentage report of like total buyers. Usually, I think it's like mid or late May timeframe, which I'm going to check that out too as well. But there's definitely parts of the market that are very, very frothy right now. And there's a lot of money flowing in from institutional investors or just other even personal investors in the actual real estate market itself right now. So again, I don't think we're in a bubble. What might happen this summer potentially, especially if rates keep going up higher and higher and higher to like 5.5%, 6% plus. What you could have is basically a massive bleed down where all of a sudden, hey, the prices are dropping pretty fast. Not like a crash, but it's like, hey, you have a month over month or year over year basically depreciation in your home, which it'd be interesting to see what happens. Some people got in their homes at very, very high prices where it's like all of a sudden the equity rolls over and it flips. Like, what are they going to do? They don't have to sell because they're probably fixed rate mortgages, but it's one of those things where, hey, if month over month you're losing money on paper, it's like, hey, you might be being impulse to sell potentially right there and potentially dump the asset and go something cheaper. So that way you're not on paper losing your wealth as much. Hey, but that's the exchange. Really, definitely our thoughts on kind of the housing crash. You think we're going to have one at all? It'll be interesting to see, really. I think the inverse point will be, hey, when bonds top out and rates top out, at that point, Redfin should do pretty well. But really, that point could be months from now, potentially. So, in that near time, it could be a lot of downside risk right there, too. So, if I was an investor in Redfin right now, I'd probably hold. I probably wouldn't buy right now. But it's definitely one of those things where it's getting pretty low price-wise and valuation-wise, especially if the market recovers and they have that margin expansion. There could be some good runway for them to grow forward. But, yeah, definitely sub, like, comment down below, and that's the exchange.